The Entrepreneur's Library, episode 177.
Welcome to the Entrepreneur's Library, the only book-centric podcast that reviews all the top-selling business books and shares authors' perspective firsthand. This is your resource to finding the next great book that will enable you to grow personally and professionally. Welcome your host, Wade Danielson.
Thank you for joining us on the EL. Today we have Jason Kelly, author of The 3% Signal, the investing technique that will change your life. I really enjoyed this interview with Jason. Not only just the before and the after, but a different way at looking at investing. And you can just tell how passionate this guy is, and that he's the real deal, and he cares about getting the book out and the information out, not so much about trying to make money off of a book. So without further ado, let's bring on Jason. Welcome, Jason, and thank you for joining us on the Entrepreneur's Library.
It's good to be here.
Will you take just a moment before we dive into your book, The 3% Signal, and take a moment to introduce yourself? Tell us just a little bit about you personally.
You bet. I started out writing for IBM at the Silicon Valley Laboratory in San Jose, California, right out of college. That was the only real job I ever had. And I learned there to write about complex topics. And I had a great editor there who really focused on surprising readers who were expecting just a work-a-day slog through complex material to find something really engaging and surprising. It was excellent. It was sort of a tech writer's boot camp there at the lab. And 4 years after working there, I finally had enough income from books I'd been writing on my own about the stock market to leave IBM and become a full-time freelance writer. And that's what I've done ever since. For the past 2 decades, I've been writing about the stock market. I moved to Japan 13 years ago, just because I'd been here on a book tour and loved the place and wanted to figure out this new culture. And so I've been living here and continuing to write about the stock market ever since. And this newest book of mine, The 3% Signal, represents what I think is the stock market's new best practice. It's really the very best of what I've been able to glean over 20 years of researching this business.
Excellent. Well, Jason, first off, thank you so much for sharing that. And now let's, you started bringing up there towards the end. Let's jump right into your book, The 3% Signal, the investing techniques that will change your life, which will be made available in here just actually a couple of days. And by the time this launches, Jason, it'll already be out. So February 24th, 2015 here in the U.S. And Jason, we're going to move quickly, but our whole goal here is to help that the listener, the future reader, get a great understanding of what your book's all about. So we formulated a couple different questions that will help us do that. And the first one is, what was the inspiration behind writing The 3% Signal?
The inspiration was noticing friends and family that had been struggling with the stock market for years. And that's actually what started me writing about the market. My first book was about mutual funds, the neatest little guide to mutual fund investing. And it was trying to help people get their retirement accounts under control. And after that, I wrote the neatest little guide to stock market investing, which is in its 5th edition now and has done very well. So over the years of writing for people and helping people with their investments, I came to realize that almost everything in the stock market is geared against the individual investor. Almost all media coverage fans emotions so that we're told to buy when the market's rising and that greed takes over, and then we're told to sell when the market's falling because we have to protect ourselves. And this is hard for professional investors to get right, much less the part-timer who's trying to just raise a family and run a career and just wants to put retirement on autopilot or other financial goals, buying a new home or sending a child to college in the ever-rising cost environment of that. And I realized people don't need another book saying, this is the PE ratio at which you want to buy. These are the charts you need to look at. This is what you got to be careful of. This is what to watch at the Federal Reserve. All of these things that are talked about in the financial media, first of all, come across as a foreign language to most people who are not doing it full time. And for some reason, decades ago, society went down the path of assuming anybody, no matter what their profession, should be able to handle their own retirement and their own financial future on their own. Somebody who might have no interest whatsoever in financial markets is expected to take over a 401k with a complete cornucopia of investment choices and manage those through this absolute chaos of financial media coverage. This is not reasonable to expect, in my opinion. And so what I wanted to put together was not another book on how to game the system, how to be smarter than everybody else, how to get in before the rise and out before the drop, and all that stuff that absolutely doesn't work. I wanted to set that all aside and give people a system that does work, that doesn't require any input from the media whatsoever, beats the market and almost all the pros over time, and is simple enough that anybody can do this, whether they're into investing or not. And that is exactly what this book is. It's the product of 2 decades of research, as I said earlier, and it is the best practice I've been able to come up with.
So, Jason, I think you've already done a fantastic job of answering this next question, but I want you at least to ask it again and allow you to maybe go into further depth if you'd like to. And the whole point of this is entrepreneurs are inundated with books, and we're trying to help them differentiate all the different ones that come across their table. So what makes your book different from others regarding the same or similar topic?
That it's not a book that is trying to show you how to be smarter than everybody else. It's not a book that says, this is how I've been so great in the stock market and how you can copy me. This is how you can duplicate Warren Buffett's results. This is not that book. This is a book that says, you know what? You're not going to be smarter than everyone else in the stock market. You may be smarter in some other part of life, and that's where you should focus. The reason being that the things that put us ahead in other parts of life, our own businesses, the way we raise our families, maybe the way we influence politics, whatever it is we do, whatever special skills we have, those skills don't work in the stock market. And I know that's a bold statement and it's hard for smart people to accept, but it's important to accept because the stock market is the world's largest social system, utterly unpredictable, despite what you may have read or heard somewhere else. It is totally unpredictable. So the thing we need to do is stop trying, stop wasting our energy on this, what I'll describe later in the interview as a zero validity environment. Stop wasting our time in this environment that doesn't help with all these tricks and gimmicks that most of the investment media and other books convince people to try that don't work. This is a system that is based on history, everything we know about the stock market. It's based on a simple time frame, and it's something somebody can manage with just 15 minutes of effort per quarter using only prices alone. And that's what really sets it apart. There is no emotion in this. It doesn't use time from somebody's life that should be devoted to other endeavors, and it doesn't allow too much stress from the financial markets to invade somebody's thoughts.
So this is kind of a different question. It's more of on how you structured the book, but how do you suggest the reader engage with your book? Is this one that they should read from front to back, or did you write it so they can kind of jump in, jump out, cherry picking information as needed?
Nope, front to back. That's the best way to go because I start out by laying out exactly why we need this approach. And, it's somewhat comes across as an affront to smart people to hear that you are not smarter than everybody else in this regard. So I need to establish that up front, that I'm not insulting the reader. I'm including myself in that. None of us has an edge in the stock market is something that's important to establish up front. So I spend time doing that and then show here's how piece by piece we're going to build this system just to try to condense the path that I walked for 20 years, trying this, trying that, trying this, trying that, to figure out what works best. And it's all distilled down to a very simple system. And the problem, this is kind of funny, but the problem is that it's too simple. I mean, honestly, Wade, if you and I were sitting in a restaurant and you passed a napkin across the table, I could write the basics of this down on that napkin for you, and it would be enough for you to go back to your investment account and actually run the system. But you wouldn't believe me. You'd say, on the back of a napkin, really? That's 20 years of research on the back of that napkin? And that's really the problem I had because I'd introduced this idea in other places. In my stock book, in fact, there's a little corner about this. But it was too short and it kind of shocks the reader. It's almost like, not the same level, but just to put it in funny terms, it's as if you went to dinner with Einstein and said, what do you think energy is? And he said, well, it's simple. It's just MC squared. And you'd say, huh? I mean, that is simple, but what the heck does that mean? That's kind of what I face with the 3% signal. It is so simple. It can fit on that napkin, but the reader needs to be taken through it piece by piece by piece to understand what each of the simple elements are and why they're there, because that's what gives the investor confidence in the system that they can safely ignore the media and just do this and it will work, but they have to have confidence in order to make that leap.
So Jason, now that we know a little bit of the purpose, the background behind the book, let's really give you an opportunity to take a deep dive into the content itself. So we take the next 5 to 8 minutes and really lay out what the future reader can expect out of your book?
You bet. I'm ready to dive in.
Excellent.
The first chapter is called Why Markets Baffle Us. And this is where I introduce a concept that comes up throughout the book called zero validity environment. And this is taken from Daniel Kahneman's book, Thinking Fast and Slow. He's the Nobel Prize winner that really delved into the way the human mind works. And one of the areas he looked at is behavioral finance. So why we make the decisions we do about money. His book is a landmark collection of the best research in that field over a long time. And I think it sheds a lot of light on why we are not good in the stock market. Money is a hard thing for us. We experience depression when we lose it, euphoria when we gain it, and we're awful at timing. And that combination makes the financial markets a poisonous prescription for most people. So this first chapter looks at why it's so hard for us to get financial markets right. The term zero validity environment is one that Daniel Kahneman introduced, and I shorthand it to ZVAL, Z-VAL, ZVAL for zero validity. And that refers to the environment and also the forecasters making mistakes in the environment. Because what you find if you track professional forecasters over long periods of time is that their average accuracy is 50%. Half of the calls we make, I'm not pointing fingers at anybody here, any of us, you, me, anybody doing this, if you make financial forecasts long enough and you track them honestly, that's the key, you will find that half of them are wrong. And this is a high enough mistake rate to crater long-term investment plans where people are getting in and making decisions along the way, which is what the financial media encourages. So this first chapter focuses on that, why we get markets wrong, why we need a system to do better, and why it's not worth our effort to spend energy in the financial markets trying to gain an edge. At the end of each chapter in the book, I include an executive summary of this chapter just to review in 6 or 8 bullet points the key parts of the chapter the reader should retain. Because this is a working book. It's not a conceptual book. It's a user's manual for an investment account. And I make it very, very ready to be used in the real world. So these executive summaries are helpful. And I just want to read the introductory paragraph to the executive summary of chapter 1. Quote, "We are bad at timing the stock market because we misinterpret our own limited experience as a proxy for larger complexity at work. Our memories change over time to make us think we knew in the past what we know now, and we mistake luck for skill. We see patterns where there are none and are unable to hone our intuition in the stock market's zero validity environment because what happened there in the past will not necessarily happen again." End quote. So that's chapter 1, and we've established at that point why it's not worth our energy to continue pursuing outperformance in a stock market where the market itself beats all the pros, so why do we think it won't beat ordinary people as well? Then the next chapter is called Harnessing Fluctuation. The idea is, okay, if we can't really know when the market's going up and when it's going down, can we just step back and figure out a way to use that whole process of going up and down? Let's just call it what it is, fluctuation. Prices rise and prices fall. Instead of trying to catch the rise and trying to avoid the fall and time it, can we just capture the profit potential of the whole thing? Flat lines are not conducive to profit. We need rises and we need falls, and we need to use them intelligently. If we can't predict them, what can we do instead? What we can do is set up a time frame, which is quarterly in this case, and set up a growth signal, which is 3% in this case. That's where we get 3% signal. All we want from a growth fund in our account is 3% per quarter. And that's what this chapter lies out. As the market rises and falls along a 50% mistake rate line, and I illustrate that with coin tosses. I do 50 coin tosses with heads sending the market up and tails sending the market down. And it's amazing, Wade, how many times you can do that. And the coin toss will produce what looks very much like a stock market chart. And that's important for people to tuck away. What we can do along that randomly generated line is produce more profit than the line itself is producing just by reacting intelligently to what it does. In other words, when it goes up enough, we automatically sell some of our stock holding. When it goes down, and when it goes down enough, we automatically buy more of that stock holding. We only need 2 funds to pull this off. A stock fund for the growth part and a bond fund for the safety part. The 3% per quarter we want is in the stock fund. When it's up 3%, we do nothing in that quarter. If it's up more than 3%, we sell the excess and put it in the bond fund. When it's up less than 3% or falls, we we use capital from that bond fund to buy the stock fund up to the 3% line. That's the whole process. And Chapter 2 introduces how this harnesses fluctuations. Here's the introductory paragraph from the executive summary of that chapter. Quote, "The stock market moves at its own pace in an up, sideways, or down direction. The resulting price changes can be used to our advantage after they've happened, no prediction required. Automating the process of buying low and selling high makes market volatility a tool to be used, not a condition to be feared." End quote. Next, we go into Chapter 3, which is titled, I can turn this page, titled Setting a Performance Goal. And this shows the background behind why I go with 3%. 3% per quarter is not something you hear very often. It's not 1% per month, and it's not 12% per year. It's specifically 3% per quarter. The reason that turns out to be the sweet spot is that annually it turns into 12.6% per year if you grow that 3% per quarter, which is 26% more than the stock market's average 10% per year over about the last 90 years or so. This is an enormous outperformance, but it's the right amount of excess performance to get before you start asking too much of the stock market. If you're trying to get 5 or 6, or just to be crazy, 50% per quarter out of the stock market, you're never going to make that goal. So every single quarter, you're going to be having to add more money to that stock side of your account, and that's not what the goal is here. The goal is to give it a nudge higher, to give it a growth goal that pulls more profit out of that natural fluctuation of the market without going too far, so you're adding undue amounts of money from the bond fund. And this chapter shows why 3% is the right amount for that. Chapter 4 is titled What Investments to Use, and this is where you find out why small companies are best for the growth side. So it's not the S&P 500, which is an index of large companies in America, but small companies such as the Russell 2000 index or the S&P Small Cap 600 index. These are indexes of smaller companies that have more room to grow, and for our purposes, they work better because they fluctuate more. We want bigger rises and bigger falls. Even though they can be emotionally hard on some investors, in this system, they are the powder behind the bullet. It's those higher rises and deeper falls that allow us to sell more on the ups and buy more on the downs and end up making more profit than the small company index, which makes more profit than the general market overall. And then the chapter also looks at why bonds are the best asset to use for safety. Some people might think that cash would be good because it's the ultimate safety. It doesn't go anywhere. The problem is cash doesn't pay anything. And over long periods of time, such as a retirement account or a college funding goal for a child, you're going to want income from the safe side too. So even though bonds are not quite as safe as cash, this chapter shows they're plenty safe, and they pay so much more than cash that's really the way to go for the safe side of things. Chapter 5 is managing money in the plan, and this goes over some brass tacks of how, for example, in a 401k or a self-directed IRA for your entrepreneurial crowd, how to handle those regular monthly or quarterly contributions to the fund, to the account. In this system, they go into the bond fund 100%, and then each quarter, half of those new cash contributions are factored into the growth target. And this is the chapter that explains how that works. The next chapter, 6, is called The Plan in Action. And this looks at some more brass tacks things, such as what type of account do you have? Is it a 401k? If so, what types of funds are in there, and how to find the right ones? You want the cheapest small company stock index fund and the cheapest bond index fund you can get. And this shows you how to tease those out of most 401k brochures, and then also how to use IRAs and honestly, whatever kind of account you have, this plan can work. That's the beauty of it. These two funds I've been talking about, a stock and a bond, are part of every investing account. So it can be run anywhere, and that's part of what makes this evergreen and able to help just about anybody. And the last chapter is called The Life of the Plan. And this is where it all comes together in a look at 3 investors who are fictional people working at a fictional company. But it's a real life scenario that takes all 3 of them with identical incomes and the exact same 401k plan through a 50-quarter time period, which is 12 and a half years from the end of 2000 to the middle of 2013. The reason it's 50 quarters is because I flipped a coin 50 times earlier. So just to kind of approximate that same experience with the real market, I use 50 quarters. And this takes these 3 investors, one who follows financial media, one who uses a typical portfolio that a financial advisor would create, and the third one who runs 3SIG, this 3% signal plan. And it shows through the real life headlines of that time period, which included the crash after the dot-com collapse, the rise on the housing bubble, then the subprime crash, and then the recovery since then on Federal Reserve stimulus. So we have two big crashes and two big bull markets in this time period, which makes it an excellent time period to illustrate how somebody running 3SIG does so much better with so much less stress than people running other more typical investment plans. And that's the book. I think by the time somebody goes through it methodically from chapter 1 to chapter 7, they see why we need this approach, the details of this approach, and how we can have belief in each part of this very simple plan. The problem is it looks too simple, so people won't believe in it. And then once we have it all together, we see how real people, fictional in this case, but people in a real life scenario would use this plan compared to other plans, why it's superior. And I hope at the end, investors are confident to really get started, and they actually can with this book. It's not theoretical. They can sit down with their investment literature and say, I'm getting rid of this stuff I've been doing that hasn't been working. I am starting this plan. I'm going to run circles around those Z-vals with only 4 check-ins per year, no more stress, nothing but the pure clarity of prices and no more noise from the financial media.
That's absolutely huge. And Jason, you shared so much information that this next question I feel like can be kind of mean, because we're asking you to take it a step further and break it down. So if the reader can only take away one concept, principle, or action item out of your entire book, everything that you just laid out for us, what would you want that to be?
That prices are all that matter. Ideas count for nothing. Opinions are distractions. The only thing that matters is the price of an investment, and whether it's below a level indicating a good time to buy or above a level indicating a good time to sell. We can know that level, and this is the system that tells us.
And do you have not that we couldn't use this as a quote, but do you have a favorite quote from your book? And we take a second to explain it?
Sure. It's from the end of the book, and it's a little bit philosophical, but I feel like even so far in the interview, we've been caught up in the details of the system. But I want to look a little bit more at the motivation, why people need this system. And this is a quote from the last chapter that sends a person off to put this superior approach to work. Quote, "The stock market is humanity's monkey mind writ large. For many, there is no greater cacophony, no greater distraction from life than the news cycle connected to financial markets. The more enlightened way to navigate the market is by letting it all go, reducing the chaos to a concise list of prices, visiting that list just 4 times a year, letting an unemotional formula tell you what the prices mean you should do, and then doing it. This higher state of investing not only performs better, it costs less and uses less of your limited time on earth." End quote.
So Jason, to let people, the worst thing about asking that question is wanting to think about it after that, wanting to think about that quote. So we'll put that quote actually in our show notes at the elpodcast.com so that people can go back and reflect more on that. But this last question obviously is a book-centric podcast. We have to ask you for a book recommendation. We're not asking you for just any, though. We're asking you that if there's only one book you could recommend based on the way that it's changed your life, created a lifestyle or a paradigm shift for you, what book would you recommend?
I'm always torn with this because it seems like I should recommend an investing book because we're talking about investing now. But if it sounds like you're going for a bigger picture of what really changed a person's life.
Absolutely.
And I can't go with a financial book for that. I have to say it's The Interpretation of Dreams by Sigmund Freud. Mm-hmm. And I'm not saying that just to sound like a big head. That book is phenomenal. There is a reason Freud is as famous as he is. And if you haven't read that book, do yourself a favor. It's 600 pages, so you can work your way through it over many months. We all have dreams, so you can use your own dreams that you experience along the course of reading that book to compare with what Freud is writing about. And the greatest part about Freud's book is that he uses his own dreams to provide analysis in the book. He's so honest about his own psyche. And even, this is not some goofy way to try to predict the future or get in touch with the spiritual realm. It's nothing like that. It's very scientifically based, and it just provides a framework for better understanding our own minds. And it's laid out, it was published first in 1899. And to this day, it is the best book on the subject. I just can't recommend it enough.
Excellent. That's the first time we've had that one recommended, so I can't wait to look that up. Very good. Well, Jason, before we depart, can you recommend the best way for our listeners to not only get more information on you, but also on your book, The 3% Signal?
You bet. Yeah, my website is jasonkelly.com, and there's plenty of information on the book there and my other books and me. And if a person just wants to buy the book, it's anywhere books are sold. But there's a nice backgrounder on my website and some good tools related to it. And I just want to say that this is not a gimmick. I'm not pushing something that you'll try and hate. This really is a life-changing investment approach. And the book, I think it's $12 or so online. And, it really should be a lot more than that. I was joking with a friend of mine saying, 20 years of work on this and it's a $12 book. And that too, I think almost the price should be higher just to show people what a big deal this is. But it's not higher. So, you can find out more information about it at my website, and you can get it anywhere books are sold.
Excellent. Well, Jason, thank you so much for coming on and sharing your book with us.
My pleasure. This was a wonderful talk.
Thanks again for listening in today. If you'd like more information on Jason or his book, The 3% Signal, check out the show notes at the elpodcast.com. And as always, if you'd like the opportunity to win a copy of this book, visit the elpodcast.com and become a VIP.
Looking for your next book idea? Head over to the elpodcast.com, where Wade shares his amazing resource, the top 10 business books recommended by over 500 entrepreneurs, with you for free. That's the elpodcast.com. Till the next time, keep it on the EL.